The Underused Housing Tax was repealed, but for Canadians who held a cottage in a corporation, the repeal arrived too late, and the $30,000 in penalties they're facing has nothing to do with the tax that no longer exists. This is Kevin. He's 71, retired, and has owned a cottage on a private lake north of Parry Sound since 1987. His accountant set up a numbered holding company to hold the property, a common structure in cottage country for liability protection. Kevin and his wife use the place every summer. When he heard about the underused housing tax, he shrugged it off. His cottage wasn't underused. How could it be? When he later heard the tax had been repealed, he stopped thinking about it entirely. But Kevin's cottage is held in a numbered company. That single detail changed everything. The underused housing tax took effect for the 2022 calendar year. It was designed to discourage foreign owners from parking money in vacant Canadian homes, a 1% annual levy on assessed value. On a cottage assessed at $580,000, that's $5,800 a year. But the legislation swept wider than intended. The UHT's definition of affected owner captured any residential property held through a Canadian corporation, trust, or partnership. A family cottage in a holding company, one of the most common ownership structures in cottage country, triggered a mandatory annual filing, even for lifelong Canadians who use the property every long weekend from May to October. The federal government eliminated the UHT effective January 1, 2025. No more filings, no more tax. But the repeal was prospective. It erased the obligation going forward. It did not reach back and cancel the filing requirements that existed for 2022, 2023, and 2024. Kevin heard repealed and assumed it meant over. It means over going forward. The past 3 years are still open. Kevin's cottage almost certainly qualified for an exemption from the actual tax, personally used by Canadian owners, not vacant foreign speculation. No tax would have been owed. But claiming that exemption required filing Form UHT-2900. No filing meant no exemption, and no filing also meant automatic penalties. The minimum penalty for failing to file a UHT return was $5,000 per year for individuals and $10,000 per year for corporations, per property, whether or not any tax was owed. Kevin's holding company is a corporation. 3 missed years, $10,000 per year. That's $30,000 in penalties on a $0 tax bill. There is still a path forward. A late submission of Form UHT-2900 for each missed year, combined with a penalty relief request, can often reduce or eliminate the corporate penalties, particularly where the missed filing was a reasonable mistake rather than willful avoidance. The CRA's Voluntary Disclosures Program also applies. Coming forward before CRA contacts you is almost always better than waiting for an audit letter. If a corporation, trust, or partnership held your vacation property during any year from 2022 through 2024, 3 things to check. First, confirm how the property was held during those years. If it was in your personal name as a Canadian citizen or permanent resident, you were an excluded owner. No filing required. No penalties. If a corporation, trust, or partnership held it, UHT-2900 was mandatory for each year it applied. Second, ask your accountant directly. Did we file Form UHT-2900 for this property for 2022, 2023, and 2024? If the answer is no, or a long pause, you have work to do before CRA finds you. Third, act proactively. A late filing with a penalty relief costs a professional fee. An audit letter costs the full $10,000 per year per property. The Voluntary Disclosures Program is available as long as CRA hasn't contacted you first. Kevin made that call. His accountant found 2 missed filings, A late submission with a penalty relief resolved the situation for a fraction of the $30,000 worst case. The cottage is still his. The tax is dead. The filing obligation for 2022 to 2024 is not.